technical analysis doesn't fail because it's bad, but because most traders use it incorrectly. In this video, I'll go over the key mistakes that make technical analysis fall apart and show how to distinguish a setup from a real entry trigger. We will go straight to the chart and break everything down in practice, without theory for the sake of theory. I want to remind you that I have my own Telegram channel where I talk about different strategies, share my personal techniques, provide access to copying my signals and post a lot of useful trading information. Subscribe, the link is pinned. Let's begin. For example, look here. Price reached the previous low, stalled, moved lower again, and now we see a strong bullish candle. That's a clear sign of a possible reversal. When two bullish candles form in a row, we can open a buy trade. We wait for a moment, enter, and observe the reaction. We found the right entry moment when another bullish candle started forming after a strong upward candle. The following bearish candle is no longer confident. That tells us the downtrend may be ending. Price moved lower, reached an even lower point than before and formed a reversal pattern. We entered a buy trade. A long bullish candle formed, followed by another one. There's a slight pullback now, but I'm confident we will close in profit. We identified the correct entry moment. We didn't blindly assume that if the previous low was reached, price must continue downward. Instead, we noticed signs that indicated a reversal. That's what it means to truly understand the chart and apply technical analysis correctly. Now we see a leveling trend forming. Look at the solid profit. Congratulations to us. The candle breaks a level and then returns back. This looks like a false breakout, which is exactly why we opened a buy trade. If we had entered short here, nothing would have supported that decision. Candlestick behavior clearly signaled a reversal. If you had traded with a trend here, it would have meant we misunderstood technical analysis. These nuances are crucial. They tell us when to enter. Many beginners confuse a setup with an entry trigger. A setup is when everything looks good. Levels, trend lines, formations, everything aligns visually. But a setup is not an entry. Very often traders mistake the setup for the trigger. A trigger is a specific event, a level breakout, a candlestick pattern, a micro trend shift, or a volume reaction. Here is a breakout of the previous level we marked. We can wait for a small pullback and then enter a buy trade. The market is already oversaturated. It has reached an extreme low. We enter only after the candle closes. This candle will close slightly smaller than the previous one. That's enough to enter. I decide to enter now because the moment is strong. My order is 900. Remember, risk only 2-3% of your deposit. At the beginning, practice on a demo account. Don't chase big money immediately. Learn the platform, test strategies for different market conditions. You will succeed. Remember, we are not here to make quick money. We are here to earn consistently in the long term. We entered at a very good moment. After the previous low was broken and price reached an extreme zone. Now we see a reversal. We choose the moment correctly. We didn't blindly follow the trend or assume price would keep falling just because several bearish candles formed. We understood that the extreme low had already been reached and entered a buy trade, and we made money. As you can see, everything works clearly, and we already have a solid balance after just 2 orders. So, what's important? You must understand the market regime. Technical analysis works worst when the market is choppy, flat with noise. A dirty market a messy chart, impulses without structure, regime changes, most traders don't filter the market at all. You must clearly understand when not to trade. Here's a quick filter I use. If price moves back and forth with no direction, I stay out. In my videos, you've seen many examples where I open a chart and say, price is jumping around, it can reverse any moment, so I'm not entering. If candles are small, similar in size, with constant wicks, that's chop. I don't trade it. If there's an impulse, I wait for a pullback like here. There was a strong downward impulse and I entered during the pullback. I don't try to catch tops or bottoms. I read the context. Even in this section, you can see the same situation as in the previous trade, and here we entered and closed in profit. Now we see a stair-step structure forming upward. When price reaches this level, another pullback is likely, possibly even lower than before. The market is cyclical and this is visible from historical price behavior. So what's the conclusion? Why might your technical analysis not work? First, you enter the level not after confirmation. We entered after confirmation and made money. Second, you confuse the setup with a trigger and enter based on appearance instead of a concrete event. Third, you trade choppy markets where technical analysis has no edge. You choose the wrong pairs, misread the chart, and enter trades that are statistically losing, basically guessing. Make one simple rule for yourself. A level is zone, but an entry is a reaction. I hope this video was useful. I remind you that I have a Telegram channel where I share different techniques, discuss levels, candlestick patterns, volatility, currency pairs, and economic news. There's also access to copying my signals and a lot of valuable trading information. Go to the pinned link and subscribe now. Trust me, it will be useful. I'll see you in my next videos. Wishing you profitable trading. Bye!